Hello, I'm with an old friend of Anat, Anat Admati, who is a professor of economics and finance at the Stanford School of Business. Thank you very much for joining us yet again.
Thank you for having me.
Now, I know that we spoke to you about your excellent book that you did with Martin Hellwig. Rob Johnson had a good interview with you about it. So I was beginning to wonder what I was going to be able to talk to you about. And then Cyprus came along, the London Whale came along. So yet again, we get fresh examples almost every day which vindicate the thesis of your book.
Yes, Martin wrote to me, imagine if we were writing the book, this would fit into like so many different chapters of the book, chapters on banking, chapters on politics, chapter on risk weights, chapter on the structure of regulation, chapter on hiding your risks and on governance. Everything is in those two cases, actually, the JP Morgan Chase, London Whale, and Cyprus.
You could do a sequel, Banker's New Clothes Part 2, actually.
Yeah. Well, it just will be more footnotes and more examples to illustrate the same points that we made, because it just precisely shows how nothing's changed and we still have huge governance problems, huge problems about the effectiveness of the regulation, and huge problem with the structure of the regulation. Such as Basel.
And I think that, I guess, exactly, you've come to the key point. Basel is a terribly complex regulatory structure, and what we keep doing, it seems to me, is we accommodate this increasing complexity, this increasing opacity that we have in the banking system, and then we create a regulatory structure on top of that, which simply entrenches the complex system, gives the bankers a windfall in terms of gaming the system yet again.
Well, Cyprus is actually very, very simple. Cyprus is like the extreme case of nothing complicated about it. Mm-hmm. It didn't require complicated derivatives. It wasn't about that. It wasn't about complicated models. It was plain old banking going crazy, because here is, and how you can see also the flaws of the regulation. Here are the Cyprus banks attracting all these investors, all these Russian investors and other depositors, with the promise of 4 to 5% interest, which is way above the riskless market rates, way more than German banks, for example, are paying depositors. Well, in order to deliver 4 to 5%, you basically have to take risk. Well, what do? Among other things, they invest heavily in Greek government bonds. And of course, the Greek government bonds are promising to pay 15%, 20%. That's wonderful life. If you can take money that you promised 4 to 5% on and turn it into 15, 20%, that's a great spread while it lasts. And you can keep doing that. And why can you keep doing that? Because the regulation doesn't count this 15 to 20% paying bonds as risky at all. It gives it a zero risk weight within the Eurozone, and so that you can fund that entirely with deposits.
Although I guess in fairness to the bankers, you could say that in a sense they just went along perhaps foolishly with the rules of the game in the sense that one bond is as good as another, and therefore buy Greek bonds because they're equivalent to German bonds. And of course we now know that's not the case.
Well, precisely. I mean, the fault here, of course, is the bankers were doing what it looks like was good for the political system, and the regulators didn't stop them. So this was a complete failure of regulation, and you can see how the regulation allows the banks to build up an enormous amount of risk, essentially risking, in this case, because it got so big relative to the country, the depositors, of course, who knowingly or unknowingly were subjected to this risk, or some other people, because on the downside, what happens? Somebody's got to bear that loss. Meanwhile, of course, people along the way were taking that return, but when it turned bad, then there was nobody there to absorb that loss, and except for the depositors or taxpayers in other countries in the Eurozone who were completely innocent as well. So now a lot of people are suffering because risks were taken and the risks turned out badly. The case of JP Morgan shows different problems. In the regulation. We can talk about that.
Yeah, and before we go on to JP Morgan, I want to get back to the question of deposits, because I think it's an interesting one.
Yes.
I know there's been great play made of the fact that some depositors took a hit, the uninsured depositors beyond a certain limit, and maybe that's understandable. But I think what hasn't been discussed in the broader context is that if depositors are simply another, say, branch on the creditors tree, albeit near the front of the queue in theory, then you really have to ask yourself, what sort of activities do we want banks to be doing? Because of course, if they're in a position where the so-called risk-free assets become risky all of a sudden, then you should be regulating, at least talking about regulating the asset side of the balance sheet. And by that I mean the activities in which they engage.
Well, clearly the activities have to be adjusted to what the funding structure to a sense. Otherwise, those who fund the banks, if these are depositors, uninsured depositors, have to look at the fact that they are lending to the banks effectively, expecting their money to be safe, but it's actually uninsured. In that case, they should worry about where they stand in the queue and whether there is actually a loss-absorbing equity to support, to kind of protect them from those risks. Otherwise, it's like, whose job is it to monitor that? If depositors think that they're safe, then they trust the regulators to keep them safe. So somehow or other, the debt has to, all investors in this system have to see where they stand when they give the money to anybody. So this is just a general governance problem. If somebody, being the bank manager or in a corporation, the managers of the corporation are using other people's money, investors' money, to invest, the question is, what are the investors thinking about what kind of risk is taken with their money, and are they getting rewarded appropriately for the risk that they are bearing? That applies to all investors. And at some point, it starts applying to depositors as well. If they think they're not protected, then maybe they want to invest somewhere else. And risk adjusted, get the appropriate return.
Or as you say, if they think they're not being protected, but of course many of them were in the position where they just thought, we're giving it's a risk-free guarantee, we're just giving our money to the bank, it's better than putting it in a mattress. And Cyprus says that shows you that that's maybe not the case, because at least mattresses don't buy credit defaults, default swaps, for example.
Well, the thing about it is that this is true for this investment, but a lot of investors in the financial markets think that that something that's too good to be true is still true, and to get 4 or 5% completely risk-free is a little bit too good to be true in the Eurozone right now. The interest rates don't allow that. So if somebody is promising you an unreal level of return, then how is that possible? How can you generate 4 to 5% in these markets with absolutely no risk?
And that's really the problem. I mean, one hopes that in an ideal world, one would hope that the low interest rate environment would actually provide some sort of market pressures for the banks to downsize in the sense that they can't generate returns. But of course, what it does is the opposite. They feel they have to use more leverage and engage in yet riskier strategies to reach that higher threshold of return.
And that's a big problem. The chasing of returns in general is a big problem because it often means taking risk. You can't usually, the market will not give you the returns unless you're bearing risk. Usually otherwise we call it arbitrage opportunities. You can't get money for sure without risk.
Which leads us to the other point that you made earlier, the London whale. Do you want to describe that a little bit for everyone, and then?
Yeah, well, the London whale fundamentally is a situation in which J.P. Morgan Chase, even in their words, took excess deposits. So once again, it's depositors' money that was actually used to take risks. They tried to play the game of describing it as a hedge, but that doesn't meet any test of any sort in terms of what they were doing, how they were compensating the managers who were doing it, or any of that. That it was really an attempt to make money in the derivatives markets, in over-the-counter derivatives markets in London, against hedge funds trading in those markets, very opaque markets that nobody sees. And in those markets, they ended up getting into a little bit of a bind with that trade, and they used strategies that are the highly speculative strategies to double up when they were losing, all kinds of trades of this sort that ended up backfiring and ended up in a big loss. Now, Obviously, when you take a lot of risk, sometimes it works out and sometimes it doesn't. The reason this came to light at all is because they lost actually a particularly large amount of money on this particular trade. But the lesson is not that they can lose money, and in this case, they did for this loss, given the size of the bank, they could absorb that loss with their equity. So their shareholders lost, and most of the time the shareholders are winning from those strategies, making money. So this time it didn't work out, which is okay, no big deal in that it wasn't systemic, it wasn't in a crisis, it didn't ruin even the bank, let alone the system. In that sense, you might say, oh, no big deal, you win some, you lose some, you make mistakes, whatever is the narrative. The lesson from this is different. The lesson from this comes from the report, indeed, of the Committee on Investigations, which showed, and even the internal report of JP Morgan, which showed severe breakdowns in governance as well as severe breakdown in regulation. Because what you saw there is their inability to really, or maybe even lack of full incentives to really control what was going on, the manipulation of models, in some cases the manipulation of these risk weights. So that goes back to the Basel complexity.
And not only that, but actively concealing from the regulators.
Yes,
and the regulators, of course, didn't have the power to do anything about that.
Precisely. They probably had the power, but once again, they didn't have the will
Regulatory capture.
To do it, because when they came to before the Senate for the Carl Levin questioning, he was insistent that they answer, and you wonder why the regulators weren't as insistent on getting answers. So when Jamie Dimon says, I don't want to tell you the information, you don't really need to know, the regulators actually have a lot of power to counter if they want to, because they really are supposed to be controlling these banks and getting information out of them. But as it was, even Diamond or some of the people higher up claim all of a sudden that they didn't understand the trade. Floyd Norris highlighted the gibberish of the presentations and that nobody really understand what all these fancy words were. And so trades were taken, higher ups were not completely sure what was being done. It did go some of it was approved, some of it involved all kinds of manipulations of the models. And then as it comes to the regulators are completely useless in really, in real time certainly, controlling this or even getting sufficient information in a timely manner. And all of a sudden you get a sort of out of control situation where a bank like JP Morgan, which is highly systemic, is able to take those risks, which this time was kind of a one-off, but I view as a real warning about what can happen in those markets and how dangerous it is to have this bank act in those markets taking this enormous risk out of sight.
The problem is we keep getting one warning after another.
Yeah.
You can argue that the Asian financial crisis was the first warning, long-term capital was the next. We had the housing problems and then 2008, and each time we seem to ignore the warnings.
Yes.
One final question. We're called the Institute for New Economic Thinking. What sort of new economic thinking do you personally think we should be doing to be consistent with our mandate?
Well, I think that the economic thinking is partly sort of how the political economy of the regulation, how to make sort of certain regulations work in an environment where there's a combination of self-interest and confusion. So sort of the issue is not necessarily, in this case, some of the new economic thinking is really kind of back to basics type of thinking and not getting confused by narratives that are actually flawed, and then taking it to sort of the policy to the policy context, how to make the economics and the political economy work.
Function the way we want to.
Yes.
And at that, we'll leave it. Anat Admati, thanks as always for speaking to us. We benefit greatly from your insights, and the book was fantastic.
Thank you very much. Thanks.